Hello, everyone, and welcome to Currency Exchange, a NatWest Markets podcast all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today. I cover G10 FX strategy out of the U.S. And today I'm once again joined by Paul Robson, who covers G10 FX strategy. Today we're going to talk about the Bank of England and the Fed, who really delivered very contrasting tones and decisions this week, which have important implications for foreign exchange markets. So, Paul, thanks very much for joining.
Thanks very much for the invitation. Like you say, back-to-back podcasts, very much looking forward to those interest rate decisions that look like they're going to echo well into the future, I think.
I think so. Let's start with the Bank of England as we record on Thursday morning. That is fresh on the top of our minds. Paul, what did the Bank of England do today and how that impacts sterling?
Well, the Bank of England left interest rates on hold. To be honest, it wasn't a huge surprise to us, nor pretty much anyone else. There was only about 3 basis points priced into interest rate futures market, so not a lot. So I don't think people had expected it. There may be a little bit of uncertainty around interest rate decisions of other central banks and whether that could have an bearing on what the Bank of England announced this week. But in the end, they delivered exactly what market economists were expecting. The odds fluctuated a little bit around some of the data. We had some CPI numbers here in the UK this week. I think if they were significantly weaker than expected, maybe people would have been a little bit more confident that the Bank of England could have cut rates today, but they just continued the same theme of inflation here in the UK being relatively sticky, not necessarily at sort of headline numbers when you add in everything, but it's the service sector inflation rate, which sort of ticked up again. You know, some of that was what was happening this time last year that isn't calculated when they look at year-on-year rates of inflation, but it's still uncomfortably high from a central bank where it has an inflation target of just 2%. So that matters. The vote count always seems to be a big focus for people. The vote count was 8-1 in favour of that decision to keep rates on hold. Remember last time it was 5-4 in favour of voting for a rate cut. So 4 members have switched from looking for lower rates to unchanged rates. We thought it would be like 7-2, maybe 2 people might have voted for a rate cut. The fact that only 1 did, I think, just made it a little bit hawkish, sort of this idea that rates here in the UK are held sort of higher for longer relative to other central banks. I think that's a key takeaway. And also the hints from the central bank about where interest rates might be heading was also slightly on the hawkish side. Certainly surprised me in how sort of solid those comments were. That the governor was talking about how it might be possible to lower rates over coming months. That was certainly in sharp contrast to other central banks who seem to be far more confident the rates are coming lower. He also said comments about how sensitive the economy is or how inflation is sensitive to growth. So he was making the point that the relationship between inflation and economic growth needs to loosen a little bit. He would talk about sort of potential output of the economy. How fast can the economy grow before inflation starts to pick up? And that's been a bit of a problem for the UK in terms of productivity, that potential outlook. For sterling, the currency rallied, which I think just plays the idea that it was slightly on the hawkish side. We do note the positive correlation between the currency and interest rates. It gave back some of those gains. I think maybe the event is out the way. We've had lots of important news, as we're going to discuss later, from both sides of the Atlantic, and I think maybe that's the key takeaway, a slightly more hawkish takeaway from the Bank of England.
Can I ask you, Paul? This is, there's a lot to think about with the Bank of England decision today and how sterling has moved in the immediate term. But how are you thinking about sterling here, maybe over the more medium term? And What is the Bank of England's, how is their sounding relative to their peers? How is that impacting how you're thinking about sterling, the evolution of sterling as we sort of head into the end of 2024?
Yeah, I continue to have a constructive outlook on the currency. I think a central bank that is cautious in lowering interest rates when others are cutting. And as I say, we've noted this correlation between the currency and interest rate expectations. And it feels as if the Bank of England stays cautious on lowering rates, we think that they cut once more by the end of the year, 25 basis points, 50 in total this year. And they come down a little bit slowly next year, but others are potentially cutting more quickly. And so the interest rate difference between the one that's in the UK and the rest of the world, I think, is going to widen in favour of sterling rather than narrow. There's also where we're going to end up in this easing cycle here in the UK. I would call it the terminal rate, and so the terminal rate in this easing cycle, the end point, where interest rates going to settle down, and it feels like that point's going to be higher in the UK relative to where we've sort of been used to it, and also importantly higher than elsewhere. And there's a number of reasons for that. We think that labour market sort of rigidities, wage growth is a bit more persistent, maybe fiscal dilution. We've got that fiscal event, the 2024 budget that comes next month. I think that all plays to inflation staying a little bit stronger for longer here in the UK relative to others. And my third point for sterling, and I make the point sort of each week, but it's a relatively slow burning story, and that is this relative political stability story that I think it's supportive of growth, not dramatically so. I think it's not going to be a game changer, but for non-residents, international investors, when they look where they might be placing their money as interest rates move elsewhere, maybe fiscal stability or instability in the past might have meant that they had avoided the UK, might turn their attention to the UK. And if that money does come to the UK and it's unhedged, then that would tend to be supportive. So it's still constructive on the currency. Short-term policy moves, that sort of endpoint to the policy cycle and relative political stability. But obviously we had another interest rate decision this week. It's moved rates potentially much more than here in the UK, but the Fed interest rate decision. I was just wondering how you saw the market reaction on that, and did anything surprise you from the Fed this week?
Yeah, it did. I would say, we were expecting this to be a very close debate between 25 and 50. We ultimately settled on our call being for 50 basis points, which ended up being the correct call in the end. Although there was certainly a lot of hand wringing and concern about the signaling around that move. But just to back up, the Fed did cut the policy rate by 50 basis points, which is an above normal size of their ease, especially at the beginning of the cycle, to move in a larger increment than what we would consider the normal 25 basis points. And so that alone is quite a dovish development. Moving more aggressively at the start of the cycle signals to us a preference for needing to move the policy rate lower in a relatively fast way in order to preempt or to prevent any further slowing in the labor market. Labor market is moderated here in the US. It's not slowing in a dramatic way, but we have returned to effectively pre-pandemic levels in the labor market here in the US. And the Fed responded to that by making a bigger move than normal to push rates back in the direction of what you would consider normal. So that on its own was the dovish takeaway. Around that decision, we got so much additional communication from the Federal Reserve, and a lot of that leaned in the hawkish direction, especially relative to the size of the cut. I think what Powell and the committee was trying to signal to the market was that we should not expect that 50 basis point moves become the standard from here. Are 50-point moves possible at additional meetings? Absolutely. Nothing is ruled out. But what I think the Fed wanted to prevent was the market boxing them in to doing 50 basis points at each meeting simply because they did 50 basis points at this one. So when we look across the universe of Fed communication alongside the cut, they release a short statement alongside the decision. And the guidance in that short statement on future interest rate moves was effectively unchanged, even though they really, they made a significant move, the first ease of this cycle. They didn't change the guidance in a meaningful way to suggest to the market to try and push the market towards aggressive interest rate cuts becoming the base case. Additionally, alongside their projections for growth and inflation, they also release what we call the dot plot, which is each individual member projects where they think the Fed funds rate will be at particular points over the next couple of years. And markets were very closely watching this number, these projections, to see what was the Fed telling us about the path of interest rates from here after delivering the larger interest rate cut. So if the dot plot had suggested we only have 2 more meetings left this year, so if the median suggested 50 basis points cumulative over that time, that would be a signal that the Fed's sort of middle ground member thinks the next 2 meetings will be 25 basis point rate cuts. Something more than that might have suggested a preference for moving in the same increment, faster pace that we saw at the September meeting. And what we got in the dot plot was that former scenario where there were only 50 basis points of additional easing for the rest of this year priced into the dot plot. What that means is that the median member believes that the pace of easing for the final 2 meetings this year is more likely to be stepping back the pace to a more normal 25 basis point pace for reductions. And so I think the goal here was to try and deliver effectively a hawkish 50 basis point reduction, move 50 basis points at the initial clip, and then try not to let the market get carried away into thinking that this was going to be the pace from here. And so at the end of the day, as we look at this on Thursday morning, we're about 24 hours removed from that decision as we record today. The dollar move we've seen has been choppy, but it has been somewhat muted, all things considered. And it seems like the market is kind of struggling to figure out it and try and square this circle, if you will, because a 50 basis point rate cut at the beginning is a dovish evolution for sure, especially relative to where we were coming from, with the Fed being very, very cautious in its policy at the beginning of the year. But alongside that dovish move, the Fed seemed to go out of its way to try and almost limit the dovish follow through, if you will. And so I think the dollar is kind of struggling to find what's that right balance between those two, what the signal is telling you from the rate cut itself versus from what the interest rate projections and the forecasts and the statement are telling you, which was a little bit more conservative, I would say.
Yeah, you mentioned the dollar there. I mean, from my point of view, when I look at the Fed and the Bank of England, sharply different policy announcements, and that feels important. You said the currency sort of struggling a little bit for direction outside the other side. So, where do you think that the dollar is heading, given your base case for the policy outlook in the Fed? Obviously, we've got a few other things, not least US presidential election, which could yet throw a curveball. But just on interest rates and the dollar, what are you thinking here?
Sure. Yeah, the presidential election stands between us and the next meeting in early November, and so there's plenty of opportunity for fiscal policy to play a role here. But if we put the election to the side for a moment and we just think about where we think the market should be putting their attention on the guidance, which was more hawkish, or on the scale of the decision, the cut this week, which was more dovish. And we think the cut matters more. And we think ultimately the risk reward around the Fed cycle is to the downside in terms of rates, to the upside in terms of the pace of rate cuts. So the dot plot, the projections suggest the median member only sees 25 basis points at each of their final 2 meetings this year. We think the risks there are skewed to the upside because we expect continued moderation, both in inflation and in the labor market. So we think that the Fed, like the market, is going to end up being data dependent. And even though their projections were relatively hawkish, we think the message sent by the decision to move 50 basis points at the September meeting, even though I think one could well argue that the data have been solid, not spectacular, but not suggesting that the economy is falling into, an imminent recession, the Fed decided to move 50 basis points even with that background. So I think a similar situation could evolve as we look ahead to the November meeting, where the data I don't think have to slow down materially to force the Fed to consider a 50 basis point move again. The reality is the policy rate is significantly into restrictive territory even after this interest rate cut. The Fed themselves believes that the neutral rate is closer to 3%. The policy rate is still around 5%. So you still have plenty of room to cut the policy rate without getting to a point where we are close to a level of neutral. So this policy rate is still restrictive. We still think there will be room for them to consider pulling forward this easing cycle, moving more aggressively. And we think the data are going to support that. And so we think that the evolution of policy risk are still to the downside, and same with growth. For the dollar, that means continued weakness in our view. And it stands such in stark contrast to what we heard from the Bank of England, as you mentioned, Paul, that the Fed is much more confident in the narrative around slowing inflation, the moderation in the labor market, and they're moving much more confidently in lowering interest rates as a result. So we think the dollar is losing prior supports, both from relative interest rates, which had for a long time been extremely high, relative both on an absolute terms and relative to many of its G10 peers, and from a growth perspective. The U.S. has enjoyed a much stronger economic outlook than the rest of its peers. We do think that that's moderating. The U.S. is a bit slowing back to the pack in our view. So in both cases, that we think the dollar can continue to weaken here as the Fed is sort of pushed into a more aggressive stance if the data evolve as we expect. So, Paul, that was a great conversation, really going through some of the differences between these two central banks and how it might impact currencies. So thanks very much for joining. And to our listeners, thanks so much for listening. If you enjoyed this podcast, please consider giving it a like and also subscribing to our channel so that you can get our latest episodes the moment they're released. Thank you very much.